Let's switch gears now and talk about a stock my next guest says is a potential beneficiary of the Fed pivot, and it's Schwab. Shares are still down 25% this year as clients have been moving cash out of their accounts and into higher yielding products. But my next guest says this so-called cash sorting could actually end and even reverse when the Fed starts cutting next year. Schwab shares are already up 10% over the past week. He says maybe they could rally another 20% from here. Joining me is Patrick Moley, who covers the online brokers and exchanges at Piper Sandler. Patrick, it's great to have you here. Welcome.
Yeah, welcome, Kelly. Thanks for having me.
So let's start with why Schwab in particular. I mean, is this one of many names you think could benefit, or do you think they're uniquely positioned?
Yeah, well, I think Schwab is uniquely positioned. Like you said, they've been dealing with this cash sorting issue. This has been going on for almost a year now. It's forced them to add high-cost short-term funding. They're paying almost 5.5% on those balances. That's almost 2% higher than their asset yield. So if they want to grow earnings going forward, one of the things they're going to have to do is they're going to have to start paying down those short-term funding balances. Once they start doing that, they can start growing net interest margin and growing earnings. So when we put this note out last week, we sensed that a Fed pivot could be coming. If you look back at historical cycles, what we found is that typically as we approach a rate plateau and the narrative starts shifting toward potential for rate cuts, clients tend to sort their cash less. And we think that that sorting will lead to a greater ability from Schwab to be able to pay down these short-term balances. And we thought at the very least it should instill confidence in investors that they'll be able to overcome some of these short-term hurdles. And we thought that would be a tailwind heading into next year.
Yeah, and not that you have to answer to this per se, but I just find it a little strange that you have a name like Schwab up 10% last week on this idea of rate cuts, and yet the Magnificent Seven were down 5%. You know, you'd think that they should also kind of theoretically or momentum-wise benefit from rate cuts. I don't know if there's anything to say about that. I mean, about the behavior of financial stocks like Schwab and whether, I guess it makes me question sort of the durability of their move, especially rate cuts usually signal a slowing economy.
Yeah, so I think, like we said, Schwab is unique in that a lot of the focus has been on this cash sorting issue. If you look back over the summer months, it's the narrative about potential for rate hikes sort of started to calm down, and then the Fed hiked at the end of July. And what we saw was a big reacceleration of cash sorting trends. So I think investors in this name have been a little bit more cautious, waiting. They want to make sure there's a better outlook, and they want to feel a little bit more confident that we won't see more rate hikes and we won't see a reacceleration of cash sorting trends.
What's going on with the balance sheet side of things? Because my understanding is, you know, taking cash out is only a catalyst to realize losses that may exist because, for instance, of rate exposures. How do those losses look at Schwab these days compared with other financials?
Yeah, well, the losses look, you know, they have losses, but if we look going forward, we don't see any issues from the balance sheet side for Schwab. If we don't get any more rate hikes, we think they're in a good position to, you know, they're saying that about $1 billion of those losses are rolling off as the securities portfolio rolls over every month. So going forward, we think that the balance sheet looks good, and they should be able to deal with this issue in the short term.
Who else, if you had to say, would you? I mean, is it the financials? You cover more the online brokerages, obviously, but do you think they would broadly benefit from the patterns you're expecting?
Yeah, I think Schwab could broadly benefit. If we get rate cuts, we could see an uplift in markets overall. They have you know, almost $8 trillion of assets under management. So I think asset management revenues, which are tied to those AUM levels, would likely see a tailwind in that scenario. I think that the outlook for retail trading, the other large business segment at Schwab, is going to depend on what the economy, what macroeconomic factors look like next year. I think that if we do get rate cuts, you could see, as stocks go up, a re-engagement from those retail investors. So we definitely think that rate cuts could drive higher revenues across many of the businesses for this name.